Welcome back to GFW Acquires. Today we're going to be doing a video explainer breaking down exactly how you can buy a $1.25 million HVAC company with no money out of your pocket, no money down, and a process you can follow. Now, I will caveat this by saying this is an actual deal here that I found, and I put in some details that can give you an idea how this can operate so you can go about the process of figuring this out for yourself. I'm going to be doing a lot more videos explaining different types of business models, different types of creative structures beyond just what we described here, and furthermore, breaking down those specific types of deal structures as well for you guys. So keep that in mind. Everything is going to be, there's no definitive ways. There's not one way to acquire a business, not one way to get into private equity. There's just a way. And you can find any way that works for you. So that being said, I'm going to break down an example of how you can get a deal done. So boom, here we have a HVAC company based on Texas. I'm based in Texas. If you want to get money invested in Texas, holla at me. So let's start with a simple breakdown about the seller and the investor. So in this case, the seller started HVAC company 35 years ago with a single van and set of tools. He grew it steadily through word of mouth and service contracts, and the business now does over $3 million in revenue with an EBITDA of $400,000. EBITDA is earnings before, interest, tax, depreciation, and appreciation. So basically like the amount of money you make after your gross, but before you take out money to put in your pocket, right? Boom. So here's the current situation. And this is common in this space. Like I said, we're in the silver tsunami. The owner is tired. He has a couple of health scares, and his wife just wants him to retire and spend more time traveling with their grandchildren, just showing up in life, okay? He's proud of what he's built, but doesn't just want to shut it down because it would basically say, hey, the last 35 years were pointless. And he doesn't have any kids that are interested in taking it over, which is a common occurrence as well. You wouldn't believe it, but it's true. And lastly, he doesn't need any sort of big upfront payment. He just really wants a steady retirement income to make sure the company stays in good hands. So a lot of times we're going to see when you're trying to acquire companies from elder people is, especially when you're younger, your perspective is, I want the money now, right? What an older individual has that typically is more beneficial for for this type of setup we're doing with ETA is they are more focused on consistent steady income between now and the end of their life. If you've done anything, if you've ever tried to do anything, you understand that the importance, like, yeah, you can go make 500K. That's cool at one sitting, but it's a lot better to maybe consistently make $10,000 a month for 2 years and work toward making that 500K lump sum. So that way, you know, everything is paid and you can have the mental clarity and focus to do that. This is exactly what's happening here. They want to just focus on living their life. They don't want to worry about operations for a company or anything like that. They just want to know, hey, we got the deal done. That means I'm getting X number of dollars every single month. And whenever the company either resells or goes into a different position or they refinance, everything's all paid back. I'm good to go. Okay. So here's a buyer. Really, this buyer could be any one of you guys. But I went ahead and chose to input someone that is probably a good fit for this, right? So, boom, we have this guy here, 32 years old. Story, working a 9-to-5 job as a facility manager at a hospital. They make around $4,500 a month and never really had any money set aside to build significant savings. $4,500 a month is around $50K a year. And their credit score isn't the best, right? They have a 600 from past mistakes. They have probably high debt right now, or they just haven't focused on putting money toward that and been focusing on living, right? But in this case, we'll call this guy Marcus, which I don't know if he looks like a Marcus, but he's always wanted to own a business, right? Not just working one. He's been working as a facilities manager, so he has experience and expertise in this field for the last 10 years, and he's worked his way up. And he's hungry to learn and willing to work, and he sees HVAC as a recession-resistant industry with huge upside for him, right? He has strong leadership skills for managing teams over the years, but doesn't have a technical HVAC background, which makes him dependent on keeping technicians in place, meaning that whenever this company is sold, a lot of times the people that are selling the company don't want the people that are already working there to get displaced or to really alter their life so drastically that they feel like they got screwed over. In a situation like this, if quote unquote Marcus is here, his strength is in managerial positions and leadership. He doesn't have a technical HVAC background. Keep the techs there. Maybe have someone become a more prominent leader in this space, and he works on what he is good at, right? That's the biggest misconception a lot of people have, is when you buy the company, you have to already know how to do that type of task that that company calls for. Who, not how. There are plenty of people that know how to do the thing. You just need to find who that person is and focus on how you can be better at what you're good at. Plain and simple. Moving forward, he has a challenge. He doesn't have any cash, and he has weak credit, so he has a limited financial profile. And that's why I want you guys to recognize that that sucks when you're going to a bank trying to get financing for a deal. And furthermore, whenever you are in that position, a lot of times people just take you out the picture. But the difference is here, we can get creative. And that's the difference about this business. You can get creative. So what does that look like? We're going to be using this thing called seller finance. What are the numbers and how can I structure the deal? So we don't have much capital, so we're going to be leveraging creative financing, which basically means you figure out any sort of way where you can do your capital stacks, meaning if you need to do this amount of capital from here and then get capital from this source and also from this source and put it all together as a stack to get the deal done, that's how you can creatively do it, right? A traditional would be going to the bank and getting a loan, and that's it. Creative financing is figuring out any sort of way to finance the deal creatively. So we're going to stack various strategies and boom. So breaking down the numbers. They currently do $3 million worth of revenue, and the EBITDA is $400,000, and they're asking for a 3.1 multiple, meaning that the company they're asking is going to be 3.1 times the EBITDA, which is going to be right here, $1.25 million. Cash flow is $400K to service that. That means every single year, right now, they're bringing in $400,000. That's before you even do anything to up that, right? This company might not have any online digital marketing in place that would drive that number from 400 to 500 within the first quarter that you own the company. This is just what they've been doing for a long time, so there's a lot of room to grow in this capacity as well. But you have $400,000 to service your debt. So how would I structure the deal? So I would do a thing where we mix seller financing with a private investor. So let's talk about seller financing. Why would a seller do seller financing? So seller financing is essentially saying, hey, Mr. Seller, you have this company that's going to be worth 1.25. That's what you're asking for, right? If I went to the bank, they would only give me 70 to 80% the value of this company, meaning that they might give this person $1 million. And then they will also charge an 8% interest rate, which means that in order for you to get the deal done, you're going to have to devalue the company, leaving the owner probably feeling a little slighted where it's like, wow, my company's only worth this, but I really want this, right? Seller financing takes the bank out the picture. It says, hey, me and you, Mr. Seller, we're going to set up terms that make sense for you. What we're going to do is you're going to act as the bank. I'll give you the $1.25 million that you're asking for. In exchange, I will want you to kind of roll a loan into this, right? So the seller may agree to seller financing because it makes their business easier to sell, often allowing them to ask for a higher price, right? Furthermore, it creates a steady income for them. Like I mentioned, when they have monthly payments, it's almost like they're the bank, right? Lastly, they can reduce their taxes, right? So whenever you sell, there's capital gains tax. So instead of being taxed 40% or so on a $1.25 million sale, meaning that they would walk away with probably something like $800,000, sorry, versus their full 1.25 plus some interest over an extended period of time, is a lot better for them. So I explained that, right? Let me give you guys some numbers here. So we say, hey, Mr. Seller, I want to get a 70% seller note from you, meaning that of that $1.25 million, we're going to use $875,000 out of what the business already generates. That's going to be paid over a 7 to 10 year period with whatever interest rate. Sometimes you can get 0% interest rates. It just depends on the seller. Meaning, like I said, there's more than one way to get a deal done. There are sellers that it just depends on who you're working with. There are people that would do a deal where you give them a little bit beginning, boom. It just depends on the motivation for that person. And it's going to be secured by the business cash flow. Remember, the company's already making $400,000 a year, and its steady has been proven, and the seller's motivated already. So they'd be like, you know what, I want to move into that next stage of my life. I'm willing to do that. If that means we can get the deal done, boom. So let's say we want to stack this with a private investor, meaning that the investor will contribute 30% the remaining 30% to that deal, right? So that $375,000. Sometimes you might want to overfund the deal, meaning that you might ask them for $500,000 instead of $375,000, so that way you have money left over in order to invest into new things like marketing, material, whatever. But the better idea is probably just to take that out of whatever existing of that $400,000 cash flow you get and invest a portion of that into the marketing instead. But sometimes you will overfund a deal. Usually that's going to be for more like equipment type of deals where you have, say, a tree hauling service and you need new machines. You can get loans against the value of the equipment, / you might want to fund the deal for that. But let's say, for instance, we have this investor here, and this mirrors an investor that I know. And so that's why I put this in here. So background, this investor spent the last 20 years as a commercial banker before leaving to manage her own investment portfolio, meaning that she was making good, consistent income as a banker over the 20 years. She learned how to put it aside, grew her investment portfolio large enough to where now she has money to invest into different opportunities. And now she's not looking for another job. She's looking for somewhere to put her money into, keep the cash flowing, and then acquire something without doing all the work. Be able to consistently get more cash flow. Maybe that beats the stock market, etc. So what motivates this investor here? So they want steady cash flow without day-to-day involvement. That's fine. Give me the money. I'll handle everything else, right? They believe that HVAC is recession resistant and is an essential service in this case. Meaning what? Meaning if the recession happens, you're going to want your AC to work. I don't care. You're going to want your heat to work. You're going to figure out how to get the money to make that work, because without that, we will perish. Furthermore, they see seller financing that's already in place, which lowers their risk, right? Meaning, say for instance, the seller is like, no, I'm not going to do seller finance. And the investor's like, yeah, I'll put the $375, whatever is left, into the deal. But I need you to, it's contingent on the fact that you can get a bank or some other type of money in the deal. Whenever you have the seller financing in place, that gives the investor confidence knowing that, hey, there's probably a good relationship with that seller, easier to work those terms, meaning that they feel safer with their investment, right? Furthermore, in this case, the investor has known and has met the buyer, Marcus in this case, a number of times. And they built a relationship. She likes his work ethic, and she believes more than anything and has faith and trust that he can make it happen. He has skills in management, and he's very grit. He has a lot of grit. So in exchange, she wants 30% of the company for $375,000 of the purchase price, and it's structured as preferred equity position with a guaranteed 12% annual return plus upside if the business sells at a higher multiple. So what's her expectations? 12% preferred return, or option to convert into equity ownership as a business is refinanced or sold. Why this deal works for her? Solar already has financing, so most of the deal is already put together. Business has $400K, meaning it has a lot of cash flow every year to work with and service the debt and pay her return. And also, her capital is collateralized by the company's assets, backed by consistent service contracts, right? So how does this look here? So boom, this means what? This means out of the before we go into that side of things, right? We're going to notice that there's two options for the private investor. So you guys mentioned there is the ownership exchange, and there's also 12%, right? Now, knowing what I just mentioned there, she's looking for 12% return, but a lot of times you can negotiate with that investor, and either they want the 12% return, sometimes they just want partial ownership, or they want a hybrid of both, and that's where you negotiate the terms. And like I said, it just depends on who you're dealing with. But let's say, for instance, you wanted the equity investor, meaning what? Hey, hi, Miss Investor. I would like $375,000 in exchange for 25% of this $1.25 million company. And you will earn your income in 5 to 7 years when we either refinance or sell this company. Meaning what? Say, for instance, the company grows and you sell it for $4 million in 5 or 7 years. Whenever you sell that, this investor makes the return on that 25%. So if it's sold for $4 million, then that $375 will turn into a $1 million check to them, right? This is good for the buyer, i.e. yourself, because there's no required monthly payments, which lowers the stress. You can focus on the cash flow. But the thing is, it's permanent dilution, which means that you only own 75% of the deal. But it's one of those things where it's like, would you rather own 75% of a grape or a watermelon? So what does this mean for the investor? Well, for the investor, they share in all the profits. A lot of big upside, if the company continues to grow. But there's risk is there's no guaranteed return. And the benefit, lastly, for you is there's no fixed payments required, meaning what? It means out of that $400,000 every year, you don't have to worry about allocating a percentage of that out to the investor, right? You can focus instead on growing the business, putting the right people in place, investing that money into the growth and operation of that business, so that way you can have a higher rate of return and thus sell the company later. And there could be contingencies within the deal. You might work out with the investor where it's like, hey, we have a 5 to 7 year term. However, if in year 3 we reach this profitability mark, we can refinance or restructure the deal if you're willing to do X, Y, or Z, right? Boom. So now we move forward to the other side. The other side of this deal looks like this. Say, for instance, the investor only wanted to earn a return, right? So there's certain type of people, and it just depends on your investor profile, meaning if you were an investor, which you would prefer? Would you prefer like that monthly check, or you have other things going on where you're okay waiting for your investment and your return in 3, 4, 5 years, right? Or 5 to 7 years, I should say. So what would it look like if you were paid from the cash flow with a 10 to 12% return? So in this example, we're going to focus on 12%. And let me show you over here. This would be you. This would be the investor. So going back over to the equity version, you have 5 years of growth. And on each of these, you're just going to pay your investor the 12% each year. So what benefits you? You keep the 100% ownership long term. It's only temporary obligation, meaning what? It means up until this 5 year mark, that's what you have to pay your 12%. But after that, if you sell, refinance the company, you still own 100%. You can continue to grow the company, right? Only downside is you must make steady payments no matter what, meaning that out of that $400K, you need to be allocating resources and debt servicing to this investor. So what is this impact on the investor? It's safe, it's predictable for them, but there's no upside if the business sells. They just get their guaranteed return and move along. Why is this good for you? Once it's paid off, the investor's out of the deal, and you can focus on growing that company, acquiring more, and doing a roll-up, for instance, right? So I want you guys to think about this. If I bring an investor as a lender, they act like a bank. I pay them interest, and when the loan is paid off, I own the business free and clear. It's exactly what it's like if you do a, if you bring them in as a debt investor, okay? Boom. However, if you bring them in as an equity partner, they don't need monthly payments, but they'll ask for a piece of the company, which I feel like is lucrative, especially if you're trying to do a first deal or two. Don't get greedy over the numbers. Focus on getting a deal done, earning more than what you're making right now, and having the upside of the sell. Furthermore, this gives control and payoff later. It gives you flexibility today, but long-term sharing. Both can buy the business with no money out of pocket. Boom. So let's go into the final stage here. Let's break down the deal if we're going to go through a equity contribution versus what it would be like on the versus what it would be like on the investor, the percentage-based one. So just annual return. So if we set up this deal where we have this $1.25 million company for sale, and we're looking for seller financing. The seller says, hey, I'll give you 75% of the purchase price out of the guaranteed returns of the company. And what I'll do furthermore is I'll bring in a private investor to supply the other $375 we need to get the deal done, right? What does that mean? That $375 is going to go to the seller, which is going to help them be happy, so they have some money now and they can get their little consistent cash flow going as well, right? Meaning what? You bring no money out of pocket. Only thing you're going to have to give up is 25% of the deal. But like I said, watermelon or grape. So how does this cash flow math work? So these are all rough. These are rough numbers, okay? So don't hold me to a T. But it's just to give you an idea of what it might look like, right? So cash flow math. You have $400K a year in EBITDA. After the seller note, i.e. what you pay back the seller every single year, is about $120K. So roughly $10K per month, right? And that'll turn into $280,000 per year left over. Once you do your profit split, that means that you're going to be taking home 270K a year, while the investor has 270K per year, right? And to remind you, that 400,000 is after the gross. So gross already is taken out and taken accounted for, etc. And that means like all your expenses are already covered. So those kind of what's left over for you to break apart. So that 400 means that you'll have $210,000 to your pocket every single year, and 70K to that investor paying them back, right? So let's say it's 5 years later, the business grows to $2 million. The market multiple, meaning what are most HVAC companies, or in this particular example, selling for, which is going to be a 4x multiple, which means your exit value is $8 million. So on that 25% that the investor put in, that $375,000, 5 years later, with that multiple, would earn $2 million. See, there's a lot more upside to this. They just have to defer that monthly payment, for instance. They just get their yearly return and move along, right, based on the profits. Or that profit can stay rolled into the company, depends on how you structure the deal. You, for instance, if this is Marcus, he'll own that 75%, and he'll make that $6 million payout on the sale of this company. Key point. The investor gets no guaranteed interest, but a huge upside if the business grows and exits big. You, as a buyer, sacrifices a piece of ownership for flexibility today, meaning that you give up some to get the deal done for now. In this setup, the investor is more like a partner, right? They don't get guaranteed payments, but whenever you grow the company sells, they will get a big piece of the upside. Next, what would it look like if we did an annual return, right? That's 12%, which is going to beat the stock market. And there's different ways to calculate this. You got different cash flow cash returns. You have cap rates, depending on if you're doing like a real estate sort of deal, etc. But in this particular example, we have our $875,000 in seller financing. Investor gives us a loan of $375,000 to get the deal done at a 12% annual return. And what does this look like? And this is the reason we're going to go to the investor. The interest rate might be a little bit higher, more favorable for them. The reason is because we can't go to a bank in our current situation. We're only making $4,500 a month, and credit's not the best, meaning that we have to be creative to get the deal done. You have to give a little bit to get more. 400K EBITDA, seller note, meaning what you pay back the seller each year is 120K. And that's going to be, I believe this is for the interest rate accounted for. If not, the number will vary. So these numbers may be a little different, but let's say the investor interest is going to be $45,000 per year, and that's if we're just paying the principal. We're not paying on anything else, and then the total obligations are $165,000 a year, meaning the remaining cash flow is going to be $235,000 a year for you to work with and do what you need to do. Key point: the investor acts like a private bank. The buyer pays the investor until the loan is repaid. After payoff, you own the company 100%. So let's say you paid off your investors, X, Y, and Z, pay back the loans, and now you sell the company for that same $8 million. Majority of that $8 million is going back to your pocket now. Here, the investor is just earning 12%. They get safe, predictable cash flow, and they're fully paid back. You get to keep the business. Over here, we've already broke this one down. The investor acts like a partner. So let's break down the last little branch of this, right? You might be asking yourself, why would this work? How is this possible? What does it look like? X, Y, and Z. Okay, cool. So why would the seller do a deal like this? Well, they get retirement income and upside if the buyer grows the business. Cool. Meaning, in this case, that they don't give a company to some, dope fiend or some crazy. I know what I said is crazy, but give the business to someone insane that's not going to actually run, operate, and grow the business, right? They're not going to put real efforts into this company and the actual growth, long-term vision for it, right? For an investor, they always say yes because they can earn double-digit returns, which means what? That they're going to beat the stock market. It's also collateralized by the cash flow in business, which is the biggest factor once you guys realize about all this. The business itself is the reason why you can do these deals. The business is already making money. It's the collateral, access to collateral. And also when you own a business like this in your own life, you might be able to use that to get loans against things and just borrow, buy, die, or something like that. I forget the actual terminology, where the long-term strategy is once you own enough assets. So for instance, right, you get the company outright once you pay your investors, right? You pay them off, you refinance the deal, everybody's paid back. You still own the company now, right? You can get loans against that company and you can live off the loans. For instance, that's an asset. So you get loans against the asset, and you won't pay, you lower your taxes doing that. But that's a different story. Lastly, the buyer, you own a $1.25 million company with no money down. Growth, exit strategy. Step one, you buy, stabilize the business. You might increase service contracts and repeat clients. Step two, you might scale. You want to scale it, add trucks, technicians, and different sorts of recurring maintenance programs. So like in HVAC, you might decide that, hey, I want to offer an educational aspect to this. Find your best technicians, get someone to come film them, create an online course for that, and earn extra cash flow through that business from that business, right? There's an example. I'm certain most HVAC companies don't have that. And you can even do like become a certified HVAC accredited, not university, but program that actually trains people to become technicians. And you get firsthand pick a litter and grow your company that way. And also build your reputation. Some ideas of how you could scale and grow. Step three, you're going to want to refinance this company 3 to 5 years later and pay out the investor and keep larger equity stakes. So what does this mean? This means that, say for instance, the company right now is at 1.25. 3 to 5 years later, it's worth that 4 or 8 million. Let's say it's worth that $4 million in 3 to 5 years. You go to the bank, they're going to give you 80% of that $4 million. Once you get that 80%, you're going to pay back whomever you owe. And what's left over is yours to keep, and now you own the business without the investors or whoever's left in the deal, right? Lastly, this depends on your mode. You might want to exit that company afterward and sell it for whatever this looks like. Or you might want to roll up more companies, meaning that you might buy different companies in different sectors that are all parallel to it and build a big service company and just put that in like a family trust or just make that your family business for the next 50 or 100 years. You might decide, hey, you only want to hang on to it for 10 years and then sell the portfolios that you build. Or it might be something where you're like, hey, I'm going to kind of pump and dump them. So after my 5-year mark, I'm on to the next deal. Or after the 5-year mark, I'm going to really go scale this one. I'm on to something else. So those are different options there. So boom, this is essentially how I would go about putting together a deal where you can buy a $1.25 million HVAC company with no money down. Let me put this right here better. And so hopefully this was something that was very helpful. Give me some feedback in terms of further details you guys want to see me break down. Something I already intend to do is break down all the different types of creative financing strategies. That's going to be a series for you guys to watch. Furthermore, what you're also going to see is I'm going to break down numbers and capital stacking. And there's some down here too I want to also emphasize. When we get into more of this, I can also break down different ways of how to scale and grow a particular type of company, right? So for instance, in this case, I gave you guys 2 examples of scaling a HVAC company through online education or just education period, right? But there's all different types of companies and all different ways to scale them and grow them. So this is another way I can add value to some of these videos and even break down another pathway where I show you guys how to go from buying this company, okay, cool, we got the deal done, how do I grow it? And that could be a part 2, right? We can do something like that. But like I said before, this is just a really simple way for you to kind of visualize and conceptualize how to get these deals done. And lastly, I wanted to say, if you fit one of these 3 things, my team and my business can help you, right? So if you're a financial consultant or someone who has a small business already and you're looking for more capital for your company, we're able to help you get access to that capital for yourself or your students. 2, we're able to help connect you with buyers and sellers, / capital partners to get your deals done as well. 3, we're going to be having syndicates and different deals that we do in our funds where we're going to be acquiring big companies around the nation in different sectors that we focus in. We're focusing right now on storage facilities and consulting practices. But in the future, there'll be different funds for different people, different structures, different folks that you'll have the opportunity to invest in with us if it fits your deal box. So that being said, give me a little bit of feedback down below. Let me know kind of what more you want in depth and explain furthermore. And I'll do my best to continue doing that going forward. And my objective with this series is just to build on every single thing, give you guys more in-depth knowledge, become the resource so you guys know that I know what the fuck I'm talking about. But also you guys get the opportunity to learn how to do it for yourself. So that way when you go on somewhere like Biz Buy Sell, you can say, oh, I have an idea how to structure that deal. I watched Gary's video on creative capital stacking using earnouts, right? Or I don't know how to do that deal because I watched Gary explain how you can bring an investor in and how you can get upside for that investor. So that's my objective with this channel in this current phase of how I'm building it. I want you guys to come back every single day for new videos. My objective is to get out videos every single day. Might be a little slower at the beginning, but this is how we're going to get started, and I hope you guys stick around to see how grand it gets. So that being said, I appreciate you guys, your time. Come back again. Make sure you follow all the socials. Everything should be linked down below. If you want to get involved with this, shoot me a DM over on the business page at GFW Acquires and Working Alley Capital. Either page works, and we will put it together. That being said, I appreciate you guys' time again. Deuces.